Most people believe the biggest investment lessons are learned early. They assume that once they understand stocks, markets, risk, and returns, they possess everything necessary for success. But the investment truth most people learn far too late is much simpler and much more important than any market strategy. The truth is that wealth is not built by finding extraordinary investments. Wealth is built by staying invested long enough for ordinary investments to become extraordinary. Unfortunately, most people discover this only after years of unnecessary mistakes. When people first begin investing, they often focus on excitement. They search for opportunities that promise rapid growth. They study the latest trends. They chase predictions. They look for shortcuts that might accelerate results. The financial world encourages this behavior. Every day there are headlines about stocks that doubled in value. There are stories about investors who became wealthy through a single decision. There are endless predictions about what will happen next. As a result, many investors develop the belief that success depends on finding the next big opportunity. This belief creates a dangerous distraction because while investors search for extraordinary opportunities, they often ignore the ordinary habits that actually create wealth. The truth most people learn far too late is that consistency matters more than excitement. A person who invests consistently for 20 years frequently achieves better results than someone who spends 20 years chasing perfect opportunities. The difference is not intelligence. The difference is behavior. Behavior determines whether compounding has enough time to work. Compounding is often described as one of the most powerful forces in finance. Yet many investors never experience its full benefits. Not because compounding fails, because they interrupt it. They stop investing during difficult periods. They change strategies repeatedly. They panic during market declines. They become impatient during slow growth. Every interruption weakens the process. Every interruption reduces future potential. This is why time is far more valuable than most investors realize. Many people focus entirely on return percentages. They compare investments based on annual performance. They search for slightly better results. Meanwhile, they overlook the factor that often matters most: time. Time allows growth to accumulate. Time allows temporary setbacks to recover. Time allows compounding to accelerate. Time transforms modest contributions into substantial wealth. The investors who understand this early possess an enormous advantage. They stop trying to predict every market movement. They stop searching for perfection. Instead, they focus on remaining invested. Another truth learned too late is that emotional control often matters more than financial knowledge. People assume investing is primarily an intellectual challenge. In reality, it is often an emotional challenge. Most investors know what they should do. They know they should stay disciplined. They know they should think long-term. They know they should avoid emotional decisions. The difficulty is not knowledge. The difficulty is execution. When markets rise rapidly, greed appears. When markets decline sharply, fear appears. Both emotions encourage poor decisions. Greed encourages excessive risk. Fear encourages unnecessary selling. Successful investors learn to recognize these emotions without allowing them to control behavior. Many people spend years learning this lesson. Some never learn it at all. Another investment truth most people discover too late is that income alone rarely creates financial freedom. High income certainly helps, but income without investing often leads nowhere. Many people spend decades increasing earnings while neglecting ownership. Their lifestyle expands alongside their income. Expenses rise. Consumption increases. Financial obligations multiply. Despite earning more, wealth fails to grow proportionally. Investors understand something different. They understand that income is only the beginning. Income creates opportunity. Investments create growth. Assets create wealth. Ownership creates freedom. Without ownership, even large incomes can disappear quickly. With ownership, money begins working independently. This distinction changes entire financial futures. One of the most expensive lessons investors learn late involves market declines. Most people initially view market declines as threats. They see falling prices and assume danger. They focus on losses. They become cautious. Experienced investors eventually learn a different perspective. They recognize that declining prices can also create opportunities. When quality assets become cheaper, future return potential often improves. The problem is that this truth is emotionally difficult to accept. Fear dominates attention during downturns. Opportunities become difficult to see. Only later do many investors realize that some of the best opportunities appeared precisely when confidence was lowest. By then, the moment has often passed. This pattern repeats throughout financial history. The truth remains unchanged. The market frequently rewards patience when patience feels most difficult. And this is exactly why so many people learn the most valuable investment lessons far too late. Because these lessons often become visible only after experience has already provided the evidence. There is another investment truth that most people discover far too late. The market rewards patience far more consistently, and it rewards brilliance. This idea sounds simple, but it challenges how many people approach investing. New investors often believe success comes from superior knowledge. They assume wealthy investors possess secret information, advanced techniques, or extraordinary forecasting abilities. They imagine that investment success requires predicting the future more accurately than everyone else. Over time, reality teaches a different lesson. Many successful investors are not successful because they predict every market movement correctly. They are successful because they remain committed to sound principles, while others become distracted. Patience allows them to stay invested. Patience allows them to continue contributing. Patience allows compounding to operate uninterrupted. The longer an investor remains disciplined, the greater this advantage becomes. Another truth most people learn too late is that avoiding major mistakes is often more important than achieving extraordinary gains. The financial world celebrates big winners. It rarely talks about the importance of avoiding big losers. Yet preserving capital plays a critical role in wealth creation. Large losses require disproportionately large gains to recover. A portfolio that loses half its value must double simply to return to where it started. This reality explains why successful investors focus heavily on risk management. They understand that protecting long-term progress matters more than chasing short-term excitement. Unfortunately, many investors discover this lesson only after experiencing painful setbacks. Experience becomes the teacher, and experience can be expensive. There is also a truth about simplicity that many people overlook. As investors gain knowledge, they often become attracted to complexity. Complex strategies appear sophisticated. Complicated systems seem impressive. Intricate forecasts create the illusion of control. Yet many of the most successful investment approaches are surprisingly simple. Regular investing, diversification, long-term ownership, patience, discipline. These principles lack excitement, but they possess tremendous power. The challenge is that simplicity often feels too ordinary. People assume extraordinary results require extraordinary methods. The truth is often the opposite. Extraordinary results frequently emerge from ordinary behaviors repeated consistently over long periods. This is one reason investing appears easy in theory, but difficult in practice. The principles are simple. The execution requires discipline. Another lesson learned too late is that financial freedom is rarely created by what you earn alone. Many people spend decades focusing exclusively on income. They work harder. They pursue promotions. They seek higher salaries. These efforts are valuable, but income by itself does not create wealth. The ability to convert income into assets creates wealth. This distinction becomes clearer with time. Two people may earn identical incomes. One spends nearly everything. The other consistently acquires investments. Years later, their financial situations may be dramatically different. The difference was not income. The difference was ownership. Ownership creates leverage. Ownership allows money to generate additional money. Ownership creates opportunities unavailable to those who rely entirely on earned income. This realization often arrives later than it should. Another truth people learn too late is that market volatility is not the enemy. Volatility feels uncomfortable because it creates uncertainty. Prices move unpredictably. News becomes alarming. Emotions intensify. As a result, investors frequently view volatility as something negative. Yet volatility is not inherently harmful. In fact, volatility often creates opportunities. Without volatility, assets would rarely become undervalued. Without volatility, attractive entry points would be less common. Without volatility, long-term investors would have fewer chances to purchase quality assets at favorable prices. The real enemy is not volatility. The real enemy is emotional reaction to volatility. This distinction changes how investors view market declines. Instead of seeing only risk, they begin recognizing potential opportunity. Perhaps the most important investment truth of all is that wealth building is usually far less dramatic than people expect. Most financial success stories appear dramatic when viewed from the end. People see the outcome. They see the wealth. They see the achievement. What they rarely see are the thousands of ordinary decisions that created the result. The monthly contributions, the years of patience, the periods of uncertainty, the discipline maintained during difficult times, the consistency maintained when progress seems slow. These actions rarely attract attention, yet they create nearly all long-term investment success. This is why the most valuable lessons are often learned late. Human beings naturally seek excitement. Investing rewards endurance. Human beings seek certainty. Investing requires accepting uncertainty. Human beings want immediate results. Investing rewards delayed gratification. The qualities that produce long-term wealth frequently conflict with natural instincts. Learning to overcome these instincts is one of the most important parts of becoming a successful investor. And that brings us back to the investment truth most people learn far too late. The greatest advantage in investing is not finding the perfect stock. It is not predicting the next market trend. It is not discovering hidden opportunities before everyone else. The greatest advantage is giving good decisions enough time to work, because time transforms consistency into growth. Time transforms growth into wealth. Time transforms patience into freedom. Most people spend years searching for something more complicated. Eventually, many discover that the most powerful investment strategy was never hidden at all. It was simply easier to overlook than to follow. And those who understand this truth early gain something far more valuable than a better investment. They gain decades of opportunity that can never be replaced. That is why this investment truth is so important, and why so many people learn it far too late.